Hey, everybody. Welcome to the podcast. Thanks for joining me. Today is actually Saturday, doing a Saturday edition here since I haven't been able to do a podcast recently. But look, we had the jobs report yesterday, and a lot of debate about what's going on with the jobs. Of course, the Democrats are saying that, hey, unemployment rate is at its lowest level in the Obama administration, 7.8%. The Republicans are saying, no way, these numbers are accurate. And look, the bottom line is that the numbers that come out each and every month, and I constantly say this, it's a numerator and denominator game. You know, you have people that leave the workforce, they're not included in those numbers. So when you have the numbers of workers divided by those looking for work, obviously if those looking for work gets lower, then what happens is the unemployment rate appears better than it is. There's going to be some months that things are actually better, and there's going to be some months that they're worse. But overall, there's a lot of people in this country that are out of work, have given up looking, or are accepting jobs that are either part-time or they're not where they want to be. So I probably wouldn't be running around celebrating that things are looking great. And and again, remember, there's adjustments made. I mean, I think there was 96,000 was the number reported last month. That was revised up to 142,000. So we had a 46,000 number revision from last month to this month. So, the market, I don't think, is moving based on that right now. And I also don't think it's moving based on the election. A lot of people believe that there was a Romney rally. I'm not sure if that's true or not. I think the market has primarily been moving on stimulus, and it is going up, and there's a gap, kind of this divergence building, where the market is moving up because of current stimulus, QE3, that was delivered, and the hopes for even more down the road. We've talked about QE 3.5 potentially coming in December. Where they will just do outright purchases of treasuries. That could happen. Then the next thing would be to look for QE4, then QE5. And the hopes are that, hey, all of the stimulus is really going to help the economy. In the short run, it has maybe improved things back from March of 2009, but many would argue, and probably myself included, that it's doing more damage than it is a good right now. And the other thing is this. If the economy was so great right now, and the unemployment rate is falling and more people are working, why on earth did they even do QE3? Why did they do it at a time where the market was near a high? That was the first time they had done that. So I think they see some stuff looking out that was potentially getting weaker. So as it is, though, those are all things that are debatable. And there's people that believe the economy is better than it appears. There's people that believe it's much worse and that we're in a recession. The bottom line is, how do we make money from this? And that's the point of this podcast. And what I'm seeing right now is we have seen a shift out of things like consumer staple type, we'll call it the REITs and the utilities, and into some of the more risk-on areas like financials, like technology, and even materials at times, the gold miners. Those things have been working. So are they just going up because it's a mean reversion and they had sold off and they're bouncing back? Or what's going on here? I think that we don't always know the answers of why the market's moving on any given day, but we want to just participate. But how do we participate and still have an exit strategy? How do we participate even though we know there's the fiscal cliff coming up and we know that the election, which could, turn things one way or the other? How do we invest in that environment? And I think you use a multi-tiered approach. Number one, as I've been preaching for months, if not years, you have to have income, high income generation, not CDs, not money markets, not savings accounts, but high income generation, things that can pay you 5, 6, 7, even double-digit returns just from the income, not from the appreciation in the asset, but just from the income. You have to have that as a core to the portfolio, I think. And that's really regardless of age and situation. Obviously, those things can change depending on your personal situation, but even for somebody in their 30s, they should have a good chunk of it in income production, not because you're using it as a typical advisor may say, hey, well, you only need income if you're old. No, you need income as total return. And that's the environment we're in. Don't fall for this just because you're young, you can be ultra aggressive routine. Y'all have seen how that works in 2000 and the year 2008. So income has to be a core. Then you move on to some things that you fundamentally believe in, whether it's individual companies or sectors that you say, I'm going to live with this. As long as I see the picture improve and I think I'm getting a good deal, I'm going to stick with those. That's a portion of the puzzle. Then I think you have to have some areas that are where you can take advantage of shorting the market. You can trade the market a little bit. So those would be areas that are more, I would say, technical in nature, perhaps, or hedging. I mean, all that whole category there. Then I think you have to have an area of constantly being in the right place at the right time, and that's a hard thing to do. But one thing that we've been working on is having a system of basically being in the top ranked ETFs, the most liquid ones, and then when they're not the best ranked, moving out of them and exiting them. And, areas that are working right now are obviously places like gold and financials and energy and even just the plain old S&P. Those are working right now. And you stick with those until they're not working. And then when they're not working, you move on to what is working. And that's a part of the puzzle. And I think if you combine all these things together, you're having a much more stable ride. It's going to allow you to participate when maybe you don't want to, right? I know there's a lot of you that watch this that are simply sitting on the sidelines. And you're saying, I'm not going to participate until after the election, until after fiscal cliff, until, right? You keep waiting and waiting for what? You're waiting, and there's going to be a time where when you are comfortable investing in the market, perhaps it's already made its move up. So what you have to do is invest with a strategy. And it doesn't mean that when you get invested, if you're buying stuff on a Monday, that doesn't mean that you're saying you're going to hold it for the next 6 months. You're just saying, as of today, I'm going to buy this. And then as long as you have your exit strategy on there, you're okay. The only time that wouldn't work is if you have a crash, right, where you just wake up and the market's down 20%. But most of you, and I've talked to a few of you that have acknowledged that you don't think that's coming. You're just worried about another big downdraft like 2000 or 2008. And the thing about both of those were there was plenty of warning, there was plenty of time to get out. And it's not that any of us knew the magnitude of those drops. But there was plenty of warning. In fact, most of you listening to this podcast probably started listening back in the day when I was discussing that. In late 2006, early 2007, there were some warning signs that the market was very, very vulnerable. Not only looking at the economy, but also looking at the internals of the market started to foreshadow a weakening. Didn't know the magnitude or anything like that. Didn't know how bad it would really be, but did know that it was rolling over. And so you often get those warning signs. And those warning signs were present last summer during the July, August. It came really fast. When that happened, and it bounced back a little bit, it did some big damage. And since then, the market has recovered because of all the stimulus. And so while there have still been some warning signs this year, in the last few weeks, we have started to see a little bit of demand pickup. And that demand has been met with less supply. And that's the two ingredients that you need for higher prices. So it looks to me like we may, over time, make a run at the old highs. And if you look here, we're going back to, late 07, the old high on the S&P maybe being 1576 or so. It's 100 points away. That's less than 10% on the S&P. I think that's a high likelihood that happens. Is it a straight line? I'm not sure. Is that going to be the ultimate top? I'm not sure. I'm just pointing out that the risk-on type trades are working right now, and we're seeing a little bit more demand. So it's caused me to get a little more invested here lately as well. And again, with the caveat that some of those investments I'm making are things that when they show vulnerability or there's something better to use the money on, I will rotate out of them and go into. Now, one of the areas, if you're looking for value, is the utility sector. And, we talked about this in one of the podcasts, I don't recall which podcast it was just recently, and I told you that I thought utilities were providing an entry point, and it was because we started to get this kind of zigzag pattern at this low period. And actually, I think we were looking at the Dow 15 utility average, and I was pointing out that was close to the 200-day moving average. It was bouncing around. I thought that was a good risk-reward trade, and you can see it's been doing quite well since that podcast, and it's an area that I've held on to. It's an area you can get about 4% on as a basket, or you can buy individual utility companies. Now, again, this area is a nice, safe place, but it's not the place that's working the best right now. What's still working the best are financials, gold, large caps. That's what's working. Healthcare. And those are the areas you may want to stay invested in, but I'm pointing out utilities as almost a bargain, so to speak. REITs are another area that were beaten up for some reason in the last couple of months, and they have started to recover as well, not coming back quite as fast as utilities. So those would be kind of more your value areas. And again, all these things are pieces of the puzzle, with the main component being all this income generation. And I think, again, if you do that, you won't have these wild swings. I meet a lot of people, and I look at a lot of portfolios, and again, even after 2000, after 2008, even people that are very nervous, and I run into these people, and let me show you a picture here of the S&P, and we'll go back to, let's go back instead of weekly, let's go do this quarterly and go back. They look at this picture. I mean, you can pull it up on Yahoo Finance, and when you pull it up on Yahoo Finance, this is what you see: up, down, up, down, up. Well, your mind, and this is the late 90s, we'll call it, up till now. Your mind wants to say, this is definitely coming, right? This is what's coming. I mean, how could it not? It's just going to fit the pattern. Well, our mind doesn't want to believe it's going up here. Our mind wants to believe it's going up here because it wants to extrapolate and complete this picture. That's the way our mind works. I don't know which is going to be. Logically, it would tell you it's probably going to pull back. I mean, it's been doing that in the past, and we have all these headwinds like taxes coming up and the fiscal cliff and more regulation and geopolitical risk and all these nasty things. Interest rates could be going up. Of course it's going to fall. But if everybody believes that, maybe it won't happen. But here's the thing. The people that I meet that come in, I talk to them and I say, do you think this is going to happen? Yeah, I really feel like, boy, this is definitely going to happen. Then I look at their portfolio, and guess what I find in there? I find 20 ETFs, 10 mutual funds. In other words, they're so spread out that they are the market. They represent the market. So what's happening is there's still a disconnect between what people feel and what they're doing with their money. So when you talk to somebody and say, you think this is going down, why are you invested this way then? I don't know. I'm not really sure. And that's the thing that we're trying to do here is make sure that whatever your belief is, you're invested that way. If you think it's going down, maybe you should invest that way. If you think it's going up, invest that way. But you don't want to think it's going down and then invest based on having a portfolio that's only going to make money if it goes up. And since we don't know, we kind of have to play the middle right now, right? I mean, I would have thought a correction would have been here by now, a bigger correction. And it looked like perhaps it was coming in the June, May, June time frame when the market started to sell off back in here. And it did. It sold off, 7, 8, 9% right in here. And then it's been bouncing back. So, we don't ever know exactly what it's going to do. It's a probabilities game. So because of that, we have to take the fundamental story, but we also have to look at what the market's doing. And that's where most people miss it. There's some very good economists out there. There's some very good people that write beautifully and have great narrative and very interesting facts and figures. But at the end of the day, their facts and figures suggest that we should be at Dow 6,000 right now, and we're not. So again, we have to participate with an exit strategy. And I think that's what we've been doing. And also, if you look at things like gold right now, which has been doing fabulous, it's at a spot, and pardon the lines here, but I'm going to leave them on here so you can see what I'm looking at. But the reason that we talked about gold breaking out. I think I wrote a blog article on karleggers.com a couple of months ago. And I had pretty much held gold, but I felt like it was about to break out. And in fact, went in and bought some gold miners for more of a trade, and that did fabulously well. You can see here we're at a point right now where it's at the top of a range that it's been back since last November and then March of this year, which is about 1738 on the gold, or 173, we'll call it, on the GLD, which is about a tenth of the gold price. I think what's going to happen by just looking at this chart and based on more quantitative easing is that we do get a pullback, and maybe it is at I don't know, maybe it's at this 50-day moving average here, and then we break out and we make a run for the high. And so I'm not really trading gold. I am trading the miners and have sold the gold miners in the form of GDX, the ETF. But as far as gold, look, if you're somebody that owns some gold bars, which is not my thing, but if you're somebody that owns that and you're saying, should I go exchange them in? I wouldn't. And if you're somebody that owns GLD and it's a small portion of the portfolio, reasonable portion, but not huge, I would hang on to it, because for me, it's not really a trade. And for somebody that wants to buy it right now, yeah, you probably could. If you don't have any, maybe you should. But I'm kind of waiting for a little bit of a pullback, maybe just a few percentage there, and then perhaps we make a run up to this old high, which is right up here around 1850 or so, or 185 on the GLD. So that's what we're doing with gold. All right, let's talk about Apple, and then we'll go ahead and wrap this video up. Apple, of course, has been really because of the heavy weighting. For those that don't know, Apple, because of its size, is a large weighting. So when you get a quote on the NASDAQ 100, it is so heavily weighted that pretty much as Apple goes, some of these indices go. And it's almost a self-fulfilling prophecy. Apple's something that I had held, made very good money on, sold it, and actually it went up a little higher after we sold it back earlier in the year. Kind of went through this sell-off, and once it started to kind of break out, we bought it back and have held on since. There's people out there that really are dying to short Apple. They think, it's a kind of a story stock. It shouldn't be going up as fast as it is, and it's just a kind of a fad. Then there's those that say, look, despite what you think, there's a valuation that is compelling here still, and they're still dominating, and the stock's going to go much higher, and it's going to go to $1,000. I think it is a story stock. I think it is a fad type of stock. But when you have people that, there's a lot of pressure to own Apple. Mutual fund managers have to own Apple. Individuals want to own Apple. They use it, they see it, they touch it. But at some point, it's going to lose its luster. I think the growth rate is going to slow down on Apple, and at some point, it'll start to fall. I don't think that's now necessarily. I don't think the iPhone 5, which, by the way, I've been trying to order, and I can't get it. I could order it online and wait 3 weeks, but I'm doing this deal where they say, come back on our site at 10 o'clock at night and try to order one from your local store, and we'll have some for you, and you can pick it up the next day. I've tried for a week straight and been unable to do that. Is that a function of not enough supply, or is that a function of too much demand? And I think it's a little combination of both, but it's probably more a function of not enough supply. But yeah, it's selling well, and I'm buying it because basically, long story short, my wife needs a new phone. She's in the old world of the 3GS, this dinosaur of a phone, and she needs a new one. And she said, being the loving wife she is, honey, why don't you get the new iPhone 5 and I'll take your old 4. And I said, oh, you shouldn't do that. Okay, I'll take it. So I'm ordering the 5 for myself, and but I can't get it. So, I guess that's positive if you're an Apple shareholder. But anyways, you do look at this technically, and it looks like it's destined to come back, to this 640 area, 644, somewhere in there, and it's at 652. So maybe one more down day, and then maybe we start to get the consolidation bounce and takes off again. That's kind of a short-term picture. It already busted through its 50-day moving average, but it did here too. So the 50 hasn't been a real relevant moving average in Apple's case. It broke through here, gapped up the next day, broke down below it, went up above it this day. It was a fake out, went above it, went down, it's crossed up and through it so many times that it's not real reliable. So I'm not really looking at that as much as I am just the big picture here. And if we zoom out and look at this on a weekly basis, you could also make an argument that this run that we had been on really, it kind of went parabolic in early 2012. Remember, and it was carrying the averages and it just couldn't come down. Maybe that particular run is over, but this is the next stop. If you're looking at this again long term, which is a 50-week moving average, and if it kind of just moves sideways at some point, they would meet out into the future, and maybe that's the case, and that could come down to there. So, but again, over time, Apple still, I don't think this run is over, but I do worry long term that an iPad mini will cannibalize some of their iPad sales. And again, these phones are so great, you don't have a huge need to upgrade. So, but for now, I'm still long Apple, and I'm a happy shareholder. Hey, have a good weekend, everybody. Thanks for joining me on this weekend edition. Don't forget, for those that are new, KarlEggers.com at the top right, there's a free subscription. And also EggersCapital.com. You can go over there, check out the money management website. And we're on Google+, Facebook, Twitter, all that. So have a wonderful day and a wonderful weekend.